Welcome to the Money Study Podcast with Jim Bishopp. In this podcast, we bring lessons on personal finance to life, helping you achieve the dignified retirement you deserve. Jim will guide you through practical financial strategies and tips to manage your money during your working life and through retirement. Now, on to the show.
Hello and welcome to the Money Study with Jim Bishopp. Jim, good morning. How are you?
Good morning, sir. I am living the dream every day, buddy. Got my first COVID shot, so we're looking forward to a little bit of normalcy in our lives before too long.
That'll be nice. Yeah, my wife got both shots. She's doing fine, and she's higher on the list than I am. She works with kids and families and things, and so they wanted to make sure that they got theirs first, which is, that's great.
Sure.
For the hermits that, work and live in their basement.
Right.
Me?
Yeah. Well, I know for those of you who see us on YouTube, and for you, Eric, you see me, but I know it's hard to believe that I'm over 55 when you see my face. But
what?
I know that's what
shocking.
People say.
I was pegging you like 37.
Sure. No, I know that's what my mirror says every day, Eric, but I don't know. Anyway, yeah.
You want to know what my scale says?
About the same as mine. Big liar.
That's right. It just says I'm done. I quit.
Yeah.
Anyway.
Step off, big boy.
Yeah. Well, and funny thing that we bring up that weight issue that I've got going on over here. We're talking about risk. No, we're not talking about risk. On the last one, on the last session, you spoke a little bit about risk and what kind of makes sense for people, what doesn't. I know that this is part of a series that you're doing. So can you kind of remind the audience what the series is going to be revolving around and then what we're talking about today?
Yep. So this is session 2, and we haven't quite decided whether we'll do 3. I think we'll do 4 sessions here. Mm-hmm. The first one we did was on why some risk might make sense for folks. So we talked about the idea that a lot of our audience is on a pension that doesn't have any direct market risk to the participant. They also, most have a Social Security record, not all, but some. And both of those sources of income are pretty stable and don't have a lot of market risk. So the way people in this sector tend to invest is as a supplemental retirement account. So given the overall picture, some risk might make sense for folks. Today, we want to talk about diversification, a little bit more about how you control that risk, right? Because we don't want it to be an all or nothing proposition. How do we manage it to some degree where it's okay for all of us? We want to do another session on staying the course and why that's really important. Once you set a strategy, not deviating from it. And then I think we'll do another one on trying to tune out the news, right? Because the news would just, we'd all want to jump off a building if we listen to the news every night. So tuning out some of that noise is really important for the investor of the world. Again, we don't want to try to, the goal of this session is not to make you a great self-investor, although power to you if you want to do that. Mm-hmm. The goal is to make you a good consumer, help you to understand the terminology, some of the basic concepts, so that when you meet with a financial advisor, you have good questions, you understand what they're talking about, you can just be a good consumer.
Yeah. And here's the thing is that I see this every time we get together. There's a reason you work with the people that you do. You work with a lot of people in public sector, those that are serving others. And also, a big chunk of those people are educators. And that's where your heart is. And that's what this podcast is all about, is educating people. And so I appreciate that. That's why I'm here, to get educated. I know that in the last podcast, we spoke about the risk. There's definitely things that you can do that are really, really risky. And then there's things that are safer. Yep. And low yielding investments comes to mind as something that you kind of spoke on. And I know that there's a place for those, but what is that place in somebody's overall picture?
Yeah. So, I think of risk. So let's talk about risk versus volatility for a second first. Risk, to me, risk is the idea that when I need the money, it's not there, right? The market is corrected, some catastrophic event has occurred. You call me and say, man, I need my money out. And we've turned some larger chunk of money into a smaller chunk of money. To me, management of volatility, those normal fluctuations and how deep and high those things go, is really what we want to talk about. So those safe investments can be a part of that longer term retirement strategy or that investment package. But safe investments are also really appropriate for short-term investment needs, right? The idea that maybe you need money when, the roof blows off the house and the hot water heater gives up. You got to have somewhere to go to get that money. Your investment accounts might not be the good source, the best source. So having some savings, CDs, money markets, things like that are appropriate there. So that's where that fits into the equation.
All right. So kind of thinking this of somebody in a situation where they've been in their career for 20 years, 10 years even. I mean, it could be earlier. I mean, you spoke last time about the different age ranges of people and possible risk they want to take and kind of their overall picture. But I think anybody who's joining us right now is asking that one question: how much risk is enough risk? And especially, when it comes to where they're at in their age and in their career. Mm-hmm. So how do we answer that question?
Yeah. I say there's three things that go into building a risk model, right? The first one is, how long will the money be invested? The longer it's invested, the more volatility, fluctuations along the way we can absorb and still have a profitable outcome. At least that's the theory. Yeah. The second one is, how well do you sleep at night, right? So my litmus test for having built a portfolio is always, do you call me in a down market and say, I can't stand it, I've lost too much money, I want to take all my money out? If that happens, I know we took too much risk when the market was good because we built a portfolio that was too aggressive and you couldn't stand it when the market went south. And the third and least important is what I think about the economy and the markets and what directions we're moving. So how we tweak that based on current conditions. But let's face it, that's the least important, because if I really knew that, I'd be on a beach in the Bahamas and drinking a Mai Tai, and people would be fanning me palm fronds and feeding me grapes. And might not know, but there's nobody doing that here. So yeah,
I if it's a trip to the beach, I'll feed you grapes. I'll just be honest.
Well, just gonna say that out crystal ball, it would justify the trip to the beach where you'd feed me grapes, but it's broken. So yeah.
All right. Yeah. All right. I don't know if that's a good thing or bad thing. Okay. So let's take those things one at a time. Right. I mean, you said a mouthful there, and there was a lot to comprehend or to digest. Yeah. So Timeframe, let's go back to Timeframe. Why is that so important for the investment decision?
Yeah. So the longer the time frame, the more fluctuations we can absorb, right? So imagine that we have a really good run and then the market falls. And when it falls, you need that money right then so let's say maybe we've invested for some shorter term goal, buying a house or, that yacht you want to buy, or whatever that number is. And you call me and say, I just found the perfect house and I need that money. Well, we built it up to some number and we dropped it off and now we need that lump sum. So length of time or that investment is important. By contrast, if we had that same fluctuation, but you didn't need the money for 20 more years, or you were drawing off it slowly, or you had some other objective, we could absorb that with the idea that historically the market has always come back and these dips are normal. And by the time you need the money, we'll be rewarded for having taken that risk. There's no guarantees to the future, as all the lawyers would tell you, but historically speaking, that's the premise. If we didn't think the market would go up, we wouldn't invest in it at all.
Yeah, absolutely. All right, let's. Speaking of which, that kind of leads me to tolerance, which was your second point. Yeah. Tolerance for risk. Break that down for me.
Yeah. So the number one problem I don't know what the number one problem. The problem with in engaging market risk, it's the hardest thing I do. How much risk can you really stomach? Because it's really an abstract idea. Can you suffer a 10% swing in the market? And what would you do? Well, that might be one question. If you're 30 years old with 10 grand in an account, a 10% fluctuation is $500. Well, okay, I can live with that. If you're late in your career and you've got $300,000 over there, well, a 10% swing is 30 grand. Well, that's half a year's salary. That starts to really sting. So making sure that you understand that risk is, tantamount. And it's the hardest thing I do. Again, the problem or the real downside to taking too much risk is if you take the money off in one of those corrections. So I'm sort of drawing graphs with my fingers. Hopefully that helps. But for those who are just doing the podcast, they probably can't hear that. But imagine that you made a bunch of money and the market dropped off. So we turned I don't want to use numbers, but we turned some large chunk of money into a smaller chunk of money. Then you said to me, I can't stand this risk. I want to take it out. So we put the money in something, one of those safe investments like you talked about, yielding 1%. Well, we'll never catch back up to that market correction. It'll take us a very long time to catch up at 1%. And what often happens is people will call me after the market's corrected or is going back up and say, I want back in. And they get back in, and pardon my French, but I say just in time to get their ass kicked again, right? Because the market's going to cycle and going to fluctuate. And so riding those fluctuations out is the only real strategy that works. And a thing that will really hurt us is if we pull money out during a down market. So building a good portfolio in a good market is super important.
Yeah, absolutely. And your third point, I know we're not going to touch on a lot because you're referring to the crystal ball and not knowing what's going to happen, and nobody has that crystal ball. But one thing, and I want to touch on this because I know that you've covered this a little bit in a past podcast, and I know that you're going to dive deeper into this in a future podcast, not necessarily part of this series. But the one thing that most people can agree on is that in the future, when it comes to the market, we don't know the market necessarily, but we do know that taxes are most likely going to be going up because of the trillions and trillions and trillions of dollars that the government has pumped into the economy. So that is the one thing that I would say that it's pretty safe to be able to say most likely in the future taxes are going to go up. And that's part of an overall plan. And like I said, I don't want to derail this podcast by any means, but something to consider and something that I know you're going to address on a future podcast for sure.
So you think a $2 trillion stimulus package out of the government, we're going to have to pay for that. And if we get the next one on infrastructure, another $4 trillion, somehow taxes are going to have to go up to pay for it? Seems like a reasonable bet. Yeah. So
I think so.
Tax management is important in our structure. So for the purposes of this audience, we normally are talking about retirement investing or supplemental retirement investing, supplemental to state retirement and Social Security.
Yeah.
There are a couple of options in there. We should probably do a whole podcast on it. Roth versus traditional. How we manage those taxes and keep those taxes, keep the most money in your pocket is very important. After tax investments, there are things we can do there too, probably beyond the scope of this, but that's really important. How much you keep versus how much we make.
Yeah, absolutely. I'll look forward to that podcast because I don't like taxes. That's just me, but I really don't like taxes. And my uncle's never been real friendly to me. So, now in the last, as you discussed in the last episode, the fact that most of your audience is in the public sector, and that's got to be very, very important for this overall discussion, right? Yep.
Yeah, it is. Again, they have, most of those people have a pension of some kind. Now, the one notable exception to that in my mind is folks in at the university system. So University of Arizona, Arizona State University, and NAU in Arizona, and maybe in other states as well, have an optional retirement plan. So it looks a lot more like a 401k. So they have this sort of bucket of money thing they have to be even more careful about. But most of our folks have this safety net of a state retirement or a pension option of some kind, and a Social Security record. Again, some public sector, public safety folks, and some teachers don't have Social Security, but most do. So those two really create a nice backdrop. So maybe if you really think about things in the whole context of your overall life, having a little more risk in those supplemental accounts, knowing we have these other two fairly safe or no direct market risks type accounts, we might be willing to take a little more risk there. But that's highly individual. Every person has to make that decision. Again, how well do you sleep at night? I say my job is to make you as much money as I can without taking more risk than you can tolerate.
Yeah. So as an advisor, how do your views on the market influence all this?
They're one of the, I guess, least important, because again, my crystal ball is broken. But I mean, we can lean in or out, be a little tactical in the way we think about our investments. So if interest rates are going up, we know that the longer maturity on a bond, the more volatile it is relative to interest rates. So we might lean towards shorter term bonds. We know that growth stocks have done really well. We might lean into value stocks trying to take advantage of a drop. So there are things that we can do, but we are not market timers. We are not the guys who are going to call you up and say, Eric, today, we think the market's overvalued. We should put all your money in cash. I've never seen that work, and I can tell you for sure that I can't do it.
Yeah. Nor would you want to. You said that before. Right. So obviously, the different kinds of investment have different characteristics.
Yeah. So real rate of return is the big deal, right? So we talked about this ad nauseum in the last one, but I'll touch on it, right? Remember that the important thing for us is, part of it is taxes, but part of it is also that we make enough rate of return that we have a positive real rate of return. That means that our rate of return, our investments grow faster than the things we want to buy go up in price. So our rate of return minus inflation is our real rate of return. If we do 8% in a portfolio, inflation is 3%, we have a 5% real rate of return. That sort of goes back to the idea you brought up about how much you keep. So that is, that's a really important part of all of that. Hope I answered the question you asked, but yeah.
It's good information either way.
Okay, good.
So I guess, again, this is kind of a very generic, basic question that I know that's not going to have a very simple answer, but how do I, and I think most people think of this, from time to time or quite often, how do I pick the quote unquote, and I'm using air quotes on a podcast,
sure,
how do I pick the right investment for me personally?
So I think that's an ongoing process. So when you come to our office, we'll try to have a conversation. We'll use some tools. We'll use a risk tolerance questionnaire just to see how you feel, how long the money will likely be invested, get some sort of baseline for us. That will sort of dictate the starting spot. The real magic, I think, is in the review meetings that we'll have with you. I like to say, you won't have to look for us. We'll look for you. We'll call you and we'll talk to you about your account. Again, the hardest thing I do is explain risk and make sure that you understand it. But we have tools for that. So we'll look at your portfolio. We'll review it against, how it's done, what we think the risks are. We have some mathematical measurements we can apply, but things we'll try to make like some people in my business love to talk about standard of deviation. Well, I would tell you 2% of the population could explain standard of deviation. So, right. So we try to put it in real money terms. We have, this standard of deviation, if we had a 10% drop in value, what does that mean to you? Can you stomach that? Are you going to stay awake at night? Are you going to call me losing your mind, or are you going to be okay and, power through it? So I hope that's the answer. It's an ongoing process that we have gotten pretty good at.
Yeah. And spoken about diversification, on many of your podcasts, obviously you've explained that beautifully, and that's very easy to understand. And I don't want you to give away the secret sauce. That's not what I'm asking you with this question, but how does someone go about figuring out how to mix different assets in a portfolio, or asset allocation, I guess is what you could call it as well.
Right.
The way you've outlined it, how does somebody go about figuring that out?
Yeah. So there are tools on the internet if you're a DIY so that's really the art of the process. And there's some science around it. What is the optimal mix of assets to give you the best rate of return with a measured amount of risk, right? So efficient portfolio theory is one of these theories out there that helps us to do that. But to break that down in simple terms, the way we mix those very safe investments, CDs, money markets, short-term bonds, the way we add longer-term bonds and stocks to a portfolio is really the magic in that. The more stock we add, the more volatility we add. The more we take stock out, add the other kinds of investments, the lower that's how we lessen the volatility. So we sort of think about it like a continuum, right? On one end of the spectrum, we got, I used to say pork bellies because that's how old I am, but now we say Bitcoin, right? Bitcoin is the most aggressive option, and burying it in a can in your yard is the most conservative. Neither one of those options is probably best all or nothing for any of us. So some mix of those kinds of things, different kinds of investments, is the right answer. There are tools on the internet, but if you come to us for advice, we have lots of tools around that will help us to build a portfolio, and then again tweak it on an ongoing basis so you really understand and can run it. Yeah.
As much as my brother-in-law likes chicharrones, I would say that pork bellies might be a good thing for me to invest in, by the barrel.
Yeah, that used to be what everybody talked about as being the most aggressive commodity. I bought pork bellies and hit the ball out of the park. Well, now nobody knows what a pork belly is, I'm afraid.
Yeah, I don't know what it is. I likened it to a chicharrone or a pork rind, as I grew up
enjoy
calling
on occasion. I'm not going to lie to you.
Yeah. No, they're not bad.
Yeah.
All right. So on the last episode, you actually we joked about, and unfortunately it's not a joke, but when somebody gets into the workforce, 401k, things like that, they set it up and then you just don't look at it again, right?
Right.
Most people just say, okay, I've got a 401k set up, I'm good to go, not knowing that they should be taking a look at it and adjusting it, making changes, so on and so forth.
Right.
So how do you, in a portfolio that is diversified and has those different asset allocation, those different classes, how do you adjust it as you go?
Yeah. So we did talk about the idea in the first podcast that too little risk might not be the right option. And if you really thought about it and thought about it carefully, you might make a different decision, but it's highly personal. You might not too, but you might. I see that, to your point, I see lots of people, again, particularly in that university system, particularly who are on the defined contribution plan, like a 401k. It's technically called the optional retirement plan or 401a, but those people sometimes will start their career, they'll buy an S&P fund and they'll just let it run forever, right? Yep. And then they get to their end of their retirement period and they go, man, I'm taking more risk than I really understood. So I think it's important for us to tweak those. So the closer to retirement we get or needing the money, we might take some risk off as we close in on that date. A 30-year-old probably doesn't want to take the same risk as a 65-year-old, right? So as we go through that first and most important piece, how long will we have the money? We might tweak that portfolio a little bit to take some risk out. I also think it's important, though, to know it's hard to take all of the risk out of a portfolio, even for retirees. So some people say, I'm going to retire. That's the day I need the money. I'm going to take the risk out. Well, I was 65, life expectancy is 85, something like that, right? I got to make that money last for 20 years. And on top of that, I probably ought to make it grow at a rate faster than the goods and services I want to buy are going up in price. Mm-hmm. So can't take all the risk out. So this is just an ongoing process and an ongoing conversation. It's something a financial advisor should be able to help you with. And we hope we can.
Yeah, absolutely. All right, Jim, we're getting to the close of this podcast. So 2 questions. What are we going to be covering on the next session? And then I'll also ask you about some resources.
Okay, so the next session, we're going to talk about staying the course, right? So if you choose to invest in anything that's not just a dirt safe CD, fixed account, something like that, anything that has some market fluctuation in it, you're going to lose money from time to time. Mm-hmm. You don't like that game, you're in the wrong game. We're going to have some fluctuations, right? Yeah. But the premise is that our long-term average will be better for having taken those risks than if we stay kind of investment, right? Mm-hmm. So we hope that the return will be better. History's proven it will be, and we hope that that's true. That's why we do it. But one of the most important things, again, is staying the course when the market turns against you, and it will. So that's what we're going to talk about in the next session.
All right. Now, I know you have a ton of resources on your website. We've spoken about before on previous podcasts. What resource do you have for the listeners today, and how do they get it?
In connection with this series, we put up 2 things. There's a white paper you can get off our section on investment basics. So I think that one you can download. You'll like that one. And then at the bottom, I think, of our homepage, there's a little investment quiz, which can be kind of fun. Just test what you know about the market, how well you understand it, and just kind of a fun quiz. But those are both resources that would be really great. And then, of course, reach out to us. We're happy to help any way we can.
Absolutely. Jim, thank you again for your time. This was a great podcast. Good information.
Awesome. Thanks, Eric. You bet.
And our last thank you goes to you, listening audience. Thank you so much for tuning in and listening to The Money Study with Jim Bishop. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Jim comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thanks for listening today. For everyone at SGI Financial Services Incorporated, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Money Study Podcast. Click the subscribe button below to be notified when new episodes become available. The opinions expressed in this podcast are those of the speaker and/or the guest and may not necessarily reflect those held by Voya Financial Advisors. Comments concerning the past performance of monetary instruments, investment indexes, or international markets are not intended to be forward-looking and should not be viewed as an indication of future results. Investment advisor representative and registered representative of, and securities and investment advisory services offered through Voya Financial Advisors, Inc., member SIPC. SJI Financial is not a subsidiary of, nor controlled by Voya Financial Advisors.
Using diversification asset allocation as part of your investment strategy neither assures nor guarantees better performance and cannot protect against loss in declining markets. Investments are not guaranteed and are subject to investment risk, including the possible loss of principal. The investment return and principal value of the security will fluctuate so that when redeemed may be worth more or less than original investment. Generally, the greater an investment's possible reward over time, the greater its level of price volatility or risk.